news already priced into the market as is, with a 17 forward multiple and a multiple on trailing earnings of roughly 20. So the news on the trade side, certainly I think the market's read Powell as being dovish. I'm not so sure he was that dovish, but that's the market interpretation, at least in the stock market and in the FX market. To me, if you're going to ask me, what's not to like, and maybe what the surprise is, it might not be so much on the growth side, but it might be on the inflation side. And I was struck actually this morning, front cover of the Financial Times, actually quoting 3 different Fed officials saying that businesses in their regions are just about to pass on cost increases to consumers. So I think the one thing you want to keep your eyes on in the next several months is what sort of upside inflation scare we might get back into the market.
Now, wait, is that why you think the Fed is not going to be as dovish as it was interpreted, because inflation all of a sudden will force its hand?
Well, look, I think that the markets right now are quite, I think feeling pretty good that the Fed's going to continue on its gradual course. The markets are already priced fully for a hike next month and priced over 60% for move by the end of the year. The big debate is 2019 and whether the Fed's going to go more. I think the markets seem to think the Fed's going to be done after 2 more hikes. But everybody's premising that on what happens with the economy. Nobody seems to be talking about inflation. And, Jay Powell came out and said, well, he's not overly concerned about inflation running much above 2%, even though core CPI right now is running at 2.4%. What I'm saying is that what the market's not factoring in, any market right now, is a few inflation surprises to the high side. And I think that's what could shake the complacency. When you actually go back to when the stock market had its jitters in the opening months of the year, it came when the bond market had its jitters at the beginning of the year, and that came on an inflation scare coming out of the labor market. I think this is going to come out of the CPI numbers in the next few months.
Scott, here we are at new highs with all that in the mix. How much fuel do you think we have here? We obviously approached these highs in a pretty methodical way. It wasn't really with a burst of energy. Do you think that makes it more or less likely that we see further follow through to the upside?
Well, Mike, I think the market has done a pretty good job of anticipating trade progress. I mean, we certainly think there's going to be progress, but this has come a little bit quicker than I think a lot of people thought, and I think you're maybe seeing a little bit of chasing in here. But when you get back to the inflation topic, I think the bond market has it right. I mean, the bond market's saying we're not going to have a consistent surge in GDP. We're not going to have a big surge in inflation. Our CPI number this year is 2.4, and if we're off, maybe it's 2.5 or something like that, but we don't see an inflation surge either. So I think the market right now is probably at fair value, if not a little bit ahead of it for this point in time. We've had a 152 earnings number out there. That's a little conservative after the first 2 quarters, but I still think, the market likely has a little bit more upside, but I would not say a lot more upside. But, Mike, this is a time in the cycle, and when you've seen a run like this is when the chasing starts. And I think it feels to me like we're in the early stages. We saw some institutional chasing in the middle of 2017. I think we're seeing a little bit more of that now. I mean, let's face it, if these guys have any major stock index that is their benchmark, I mean, they've got to be in this thing, and they've got to be buying. And so I think people are starting to chase a little bit too, but, we're not far above fair value or anything like that.
It's interesting to hear you say that, Scott, because I would argue you've been pretty constructive on the overall markets all year long. So are you saying you're taking it down just a touch?
Well, Carl, I tell you, I think our range was 2,800 to 2,900 for year-end for the S&P 500. Obviously, we're at the toward the top end of that range right now. Like I said, our earnings number might be a little conservative. Our target might be a touch conservative, but I don't think it's a lot conservative, and we certainly want our clients to stay invested. When we look out over the next 12 months, 12 months from now, I think you could see the index up, let's call it 5-6%. You tack on another 2%. So, you're looking at 7 or 8% total return out 12 months. If that's the case, and that's what it looks like to us, we still want our clients in this thing.